Good afternoon and welcome to another edition of Sector Spotlight. My name is Chris Galitri. I'm an analyst on the housing team here at Hedgeye, and I'm joined in the studio by housing sector head Josh Steiner. Today we will run you through our 2017 outlook on housing, and we will also answer the questions: are millennials a big drag on household formation, and is the divergence in pending and existing home sales meaningful? If you have any questions, please submit them in the comment section below the video player. And without further ado, Josh, take it away.
Great. Thanks, Chris. And thanks, everybody, for taking the time to join us this afternoon. So I put together about 30 slides or so. And, I was hoping what we could do is just, run through these to, to do a couple things. One is to really, hopefully, educate people a little bit on both housing from a fundamental sense and also from an equity investment standpoint. And we're going to sort of do that across, a couple of different durations. We're going to look sort of bigger picture at where we stand in the housing cycle, and zooming in a little bit where things are sort of currently relative to sort of a more intermediate term, both past and outlook. And then finally we'll go through what I think is sort of one of the biggest risks out there. We'll spend a fair amount of time talking about that. So without further ado, let's kind of dive in here. The first thing, just on slide 3 here quickly, this is really just a snapshot across the housing landscape. This is sort of, even to back up a step, we take a very fundamental approach to thinking about investing in housing equities and the housing market itself fundamentally. And we really think about it through, a supply and demand lens. And we like to say, as is said often at Hedgeye, that prices get set on the margin, right? So it's that most recent data point, that most recent inflection that matters, and that's really the premise of the red-green coding on 3. It's a simple heat map framework. Green is good, red is bad. Is it getting better? Is it getting worse? Is it bad and now getting less bad? That sort of thing. And we break it into 4 categories. So we've got prices, home prices at the top there. We've got the existing home market below that, then the new home market below that, and then we've got sort of a collection of miscellaneous things below that, things like rates and affordability, and how are the stock prices themselves doing is basically a leading indicator. So let's dig in a little bit here. So, starting with the big picture, slide 5, this is sort of a longer-term snapshot of sales of existing single-family homes in the U.S., and it's in millions here. You can see that in 2016, there were 4.8 million homes sold, existing homes sold in the U.S. That's up about 1 million from where things were just as recently, as the sort of the belly of the last cycle. And so, we're definitely off the bottom here quite a bit. You can see that in the last cycle we got up as high as 6 million. But I think the last cycle obviously was a bit overinflated, a bit ahead of its ski tips. So I think, realistically, that's not a feasible expectation for this cycle. Now, to be fair, population growth and household growth are important things to keep in the back of your mind. So you can see that the cycle peaks get progressively higher over time, as you'd expect with a growing number of households and so forth. So anyway, the existing home market has really been in expansion since 2012, following the great run-up. 2008, 2009, 2010, and even 2011 were really all recessionary years for the housing market. Basically no progress whatsoever, and you can see that reflected in those numbers there. Basically sub 4 million single-family existing home sales per year. And since then, we've moved up just shy now of 5 million. If you go to the next page, so that was the existing market. This is the market for new construction, new homes. And what's interesting about this chart, so first off, take a look there at the x-axis. It goes all the way back to 1955. So we're looking at 60 years plus of data. And what's interesting about the housing market, obviously it's very cyclical. So you've got sort of recurrent troughs, recurrent peaks, certainly a central tendency. And specifically what we're looking at here is residential construction spending as a percent of GDP. In the prior cycles, you've seen resi spending trough out in the low to mid threes as a percent of total GDP. And then peak typically in the sort of 5 to 6% range. In this most recent cycle, though, both the peaks and troughs were very exaggerated. So we got all the way up almost to 7% back in sort of the heyday of the last bubble there in late 2005 through first half 2006, and then corrected all the way back down, as you'd expect, to really all-time lows in terms of construction spending, down to 2.4%. And since then, we've had a pretty good rally back to 3.7. So, I mean, if you think simply about 3.7 relative to 2.4, you're up 50%. But the reality is that even bouncing all the way back here to 3.7 really only puts you back sort of in line with prior cyclical troughs. And that's why we think that from a longer term standpoint, the housing market, at least as far as new construction and new home sales is concerned, remains very favorably asymmetric, meaning there's still a lot more long-term upside relative to the downside risk. So if we go to the next page, so that was resi construction. This is starts, and this is an interesting one because it really gives you context for a few different things. So first of all, if you look back historically, and here we're going back now to 1972, if you look back historically, you can see that housing starts have generally peaked out around 2 million. So way back in the 70s, we peaked at 2.5 million. In the late 70s, 2.2 million, then around 2 million in the early 80s. And then you could sort of argue that that sort of late 90s was kind of a mini peak ahead of like the tech wreck recession. And then we sort of powered on through the real bubble-fueled era there up to about 2.3 million. And then you can also see that the troughs historically had generally been around 900,000 units per year, whereas in this most recent period we got actually sub 500,000. So we've bounced back now to about 1.25 million. This is on total housing starts. And if you look back relative to prior cyclical troughs and peaks, that basically creates sort of a 2-to-1 upside-downside asymmetry, right? Where you've got about 60% upside to prior cycle peaks and roughly 30% downside to prior cycle troughs. And to put it in perspective, I think it's important to sort of understand what housing is. Housing is an incredibly what we call autocorrelated asset class, which tends to move in long cycles from trough to peak and then from peak to trough. In other words, it doesn't go from trough to median back to trough. It goes from trough to peak, and that's why it's a cycle. So now if we look a little bit more recently on slide 8, here we've got the trend in housing permits. You can think of permits as being roughly analogous to starts. So you've got really 3 categories here. You've got total permits, which we show in black there, and then you've got multifamily permits, which are really anything that's not a single-family house in blue, and then we've got single-family permits, which are in gray. And what's interesting about this is, so we've really got the post-recessionary period here, 2010 through 2016. And I guess a couple observations. One, from a total starts, or rather a total permits standpoint, 2016 was notable in that it was the first year in which total permits were actually down year over year. Not by a lot, down 1%, but pretty stark contrast to what had been pretty steady growth there for the preceding 6 years. And really the heyday for housing sort of comeback was 2012 and 2013, right? So 2008, 2009, these were the years when housing was really struggling there in the throes of the recession. 2010, 2011, the sector was sort of consolidating, was trying to find its footing. And then in 2012, that was kind of the first year when you really started to see housing make a demonstrable comeback. And you can see that in the total permits numbers being up 33% in 12, 19% in 13, and then a relatively solid 7 and 12% in 14 and 15, before being down most recently in 16. And if we drill down on sort of what was causing that, there's two pieces here, right? You've got multifamily and you've got single family. And multifamily has just been on an absolute tear since the recession. So up 9% in 2010, up 30% in 2011, 50% in 2012, 20% in 13, and then 12 and 17% in 14 and 15. I mean, that's an incredible run. But in 2016, it was down significantly, down 11% year over year. And I think that has a lot to do with the fact that that market has largely become saturated, and the affordability constraints around it have become such that it's very difficult now to get as much growth as we'd seen in the past. Kind of a different story, not quite the opposite, but almost the opposite story on single family. So if you go back and look at 2010, 2011, you can see that single family took a lot longer to begin to recover than multifamily. So multifamily was very much in recovery as early as 2010. Single family, on the other hand, was up, a pretty pedestrian 2% in 2010, and then it was actually down 6% in 2011. It wasn't until 2012, 2013 that single family really started to hit its stride again. They're up 24%, up 19%, and then up 3% and 9% in 2014 and 15, and still a respectable 5% in 2016. So, that's kind of the most recent, 5, 6, 7 years in the housing market on the construction side. So now let's take a look. If we go to the next page here. First of all, what causes housing demand? Well, the primary driver of housing demand is household formation. And you can look at this chart, which goes back. This is monthly data. We pull this out of the Census Bureau's website. Basically, the CPS, Current Population Survey, puts out monthly numbers. So what they do is they survey 50,000 American households by phone every month. So it's a pretty robust survey, robust sample. And they basically measure growth in households. And you can see that the numbers comport pretty closely with reality, right? 2008, 2009, 2010 were all very lackluster years for household formation. Obviously, the economy was not in a good way during that period, and you can see it reflected in those formation numbers. Really, since 2012, though, and again, that's the period at which certainly the single-family market for housing broke out. Since 2012, we've basically been running in sort of a 1 to 1.5 million range for household formation. And most recently, we've been running, this is the rolling 12-month average, which we're showing there in red on slide 9, but running at 1.3 million in terms of a rolling 12-month average. The most recent number was definitely a little weaker, 1.07 million, but these numbers do tend to bounce around a bit, so I wouldn't get overly concerned by a single month. But the point is that if you're forming 1 to 1.3 million households per year, that's a pretty healthy level of household formation. And we'll come back to this in a little bit. Slide 10. This is what I sort of jokingly call affordability for dummies. It basically looks at the last 30 years, and it's a very simple framework. There's actually numerous frameworks through which you can sort of view or think about the affordability construct, different lenses you can sort of look at it through. This is one that I think is pretty straightforward, fairly simple. And it just looks at the median mortgage payment relative to the median rental, or rather median income. And what it tells you, again, is that, housing moves in these long or autocorrelated cyclical paths where it moves from trough to peak to trough to peak to trough to peak. And because it has a central tendency, because it tends to dislocate positively and negatively in sort of a predictable range, what you find is that you can really sort of dissect or break this down into simple quintiles, meaning your finding the bottom, second from the bottom, middle, second from the top, and top fifths of the range, and sort of color coding those appropriately. And really what it tells you is that when it's at the bottom of the range, which is green is good, that housing from both a fundamental and an investment standpoint tends to be very asymmetrically favorable. Affordability is extremely compelling, and this is going to tend to create a long-term durable tailwind that becomes investable, both at the personal level and at the equity level. That darker green is sort of the second quintile, and that's where we are today. And you can see we're still at the very low end of that range, because you can see that that lighter green, that bottom quintile, really is only just sort of giving way to that darker green. The blue squares there are the midpoint, which would matter if housing weren't autocorrelated, but it is, so it doesn't. And then you've got orange, which is sort of starting to get a little dangerous. But again, remember, we're talking about 10 years here, so things can stay unaffordable, frankly, for quite a long time. It's really when you get into the red that things get extremely dangerous. So obviously, that's where we were in sort of the heady days of 2005, 2006, 2007. Also where we were in the late 1980s, very early 1990s. Both those were extremely dangerous periods, either to be buying a house or to be investing in anything that sort of derives its economic basis from housing. So we're fortunately on the other end of that, and this is sort of an easy way to think about it. So with that as sort of a bigger picture backdrop, let's maybe take a little bit closer look at how things are going more recently. So pretty interesting. Slide 12 is just sort of a performance snapshot of what's been going on in the sector. So 2016 was pretty much a poor, lackluster year from a performance standpoint for housing-related equities. You can see we've got the two housing ETFs there, ITB and XHB, out towards the right, essentially flat on the year. XHB down 1%, ITB up 1%. Then you've got the S15, which is the S&P home building sub-index, down about 5%. That's basically got more direct exposure to the builders, worst performing subcategory in the group. Fast forward to 2017, now year to date, and pretty much the exact opposite story. You've had ITB and XHB sort of at or near the head of the pack in terms of performance year to date. And that S15 category, which is really home builder specific, has just done extremely well, up 16%. So if we go to the next page, 13, just more for education purposes, but one thing to understand about housing stocks is that they are tremendously seasonal. And it's a funny thing, the seasonality does not overlay with the normal seasonality in the housing market. In other words, the housing market tends to be very quiet and sort of dormant in the winter months. And then it really picks up in the spring and into sort of the early summer, and then kind of cools off in the fall and again gets very quiet in the winter. The housing equity landscape is almost the exact opposite. Where you really make your money investing in housing stocks tends to be in the months of November, December, January, and February. And then the rest of the year tends to be very quiet. And what this chart on 13 shows is the average monthly performance over the last 20 years, or from the 1996 to 2014 timeframe, which is when we put this analysis together, looks at that performance. And so, what's interesting about this is it's, this is a pretty reliable indicator for what you can sort of baseline expect. In other words, not to be overly simplistic here, but over this 20-year time frame, if you basically put housing exposure on the long side from November through February and sort of went to the beach for the balance of the year, frankly, you would have done reasonably well. And we tend not to be that simplistic here at Hedgeye, but we are sort of willing to acknowledge when something is in fact, something that recurs quite regularly as this phenomenon does. So anyway, we just throw that out there. I think part of the reason I'm flagging it is the fact that, yes, home builder stocks have really been in fuego here year to date, but based at least historically on how these stocks tend to perform in the January and February months, that should not really come as a big surprise. So now let's look, I guess, a little bit more recently at some of the trends in the fundamental market and what's going on here. So this first chart on 14 is just a quick look at the new home sales market. So basically, these are thousands of units, SAR, seasonally adjusted annualized rate, just going back to sort of late 15 through the most recent data point, which is January 17. What's interesting about new home sales is that really for the bulk of 2016 up until really November, new home sales were growing year over year at sort of a double-digit rate, anywhere from 10 up to 20%, depending on the month. But in the most recent 2 months, the growth has slowed down very significantly. So you can see December of 2016 was basically flat year over year, and January, though up year over year, was up against a relatively easy comp, which is going to become significantly more difficult there beginning in April. If we look on the next slide, we shift gears or focus here from the new home market to the existing home market. There's not a whole heck of a lot going on in the existing home market, and there hasn't been for some time. This is pending home sales, which is a little different than existing home sales, only in the sense that pending home sales reflect the point at which a contract to buy a home is signed, whereas what's called an existing home sale is when the actual closing takes place. And those two things, the contract signing and the actual closing, tend to be offset from one another by anywhere from 4 to 8 weeks, typically a month and a half on average. And what you can see is that, again, in 2015, up until basically early 2016, pending home sales were growing at a pretty good clip, but decelerating. But for certainly the last 6 months, even arguably 8 months, there's been zero growth in sales of existing homes across the country, literally just flat year over year. So on 16, just something I would call out from sort of a shorter term standpoint, but pending home sales lead existing home sales because pending home sales are the contract signing and the existing home sale measures the closing. And so one is the leading indicator for the other. What's interesting here is that there's actually been a pretty good divergence of late between the two. In other words, pending home sales have been trending down here for a little bit, whereas existing have been trending up. And we think that that is due for a pretty severe course correction on the existing home sale side, which actually just put in a very robust number when it came out a short while ago. So we think that that next print in existing home sales is likely to be a pretty big disappointment. So that's a quick look at the demand side. Let's shift gears here for a minute and look at the other side of the fundamental equation, which is supply. And this is where things, frankly, get very interesting. So slide 17 shows the number of existing homes for sale across the country. And this is units of inventory. And right now, it's 1.69 million, which is an all-time low. So to be fair, they've only been collecting this data since the turn of the century, so it's only 17 years worth of data. But it is what it is. It's an all-time low. Now, inventory is not seasonally adjusted. And inventory does tend to wax and wane with the season. It tends to be lower in the winter, higher in the summer. So you do need to take that into consideration. But the point is, even versus prior winter months, as you can see on this chart, we're at an all-time low. There's just not a lot of supply out there. And we've looked into this a lot, and there's really about 7 or 8 different reasons for why inventory is so tight. And I'm not going to go through them all here, but suffice it to say that we think the tight inventory is not going to go away anytime soon. In fact, it looks like it's going to continue to get worse. And we'll come back to why that matters in a minute. But slide 18, similar to the prior slide, only instead of units of supply, here we're looking at sort of what's referred to as month supply, which is a very simple calculation. It's basically just looking at the current inventory level relative to the current sales rate. One thing to bear in mind is that the sales rate is seasonally adjusted, but the inventory units are not. And that's why you see this recurrent seasonal fluctuation in this month's supply reading. Regardless, at 3.5 months of supply, it's an incredibly tight market. The general sort of, back of the envelope rule of thumb is that 6 months tends to be this sort of balanced market where neither the seller nor the buyer is sort of, imbued with excess power in the negotiating process. So 3.5, very tight, clearly very much a seller's market. Slide 19, I think this is kind of an interesting chart. We ran this analysis a little while back, but it basically looked at 15 years worth of data. And what it measured, it sort of took, it took supply and it sort of converted it into a histogram, a decile-based histogram. So, it said, okay, is inventory in the bottom decile, the next decile, and so on and so forth. And then, based on where that inventory measure fell, we evaluated subsequent price performance in housing equities over the 3, 6, 9, and 12-month periods. And not surprisingly, the output was exactly what you would sort of expect. When inventory is very tight, you see very strong rates of home price appreciation, and that's on the left. When inventory is very significant, very bloated, you see actually significant rates of home price depreciation. You can see that on the right there. So when you're in this bottom inventory like we are now, historically you've seen home price appreciation really in the high single digits. So anywhere from sort of 9, 10, 11% is not unreasonable. And the reason I bring that up is if we go to the next slide, slide 20, this is what home prices are actually doing. So this is, these are two series. This is the CASE-SHILLER 20-city series in black and the CASE-SHILLER National Home Price Series in pink. And what it shows is that whether you're looking at the 20-city or the national, in both cases, home price trends are actually beginning to accelerate. I wouldn't call it sort of anything, phenomenal, but the reality is the trend is the trend, and it's definitely speeding up here. So to give you sort of perspective, middle of last year, home prices were growing at about 4.95%. Fast forward to the end of 2016, and this CASE-SHILLER data comes out on a pretty significant lag, so the most recent data we have is December, and it's a 3-month rolling average. So really, effectively, what you're looking at is November, and if you wanted to take it a step further, you'd say those are closing values, which were actually contractually negotiated 6 weeks earlier. So really, this is sort of a snapshot of what was going on kind of in the mid-fall, call it a month or so before the election. The point is, prices are accelerating. They've sped up basically from just inside of 5% now to 5.5% to almost 6%, depending on the series. And that has a lot to do with this tight supply situation that we've talked about. Another thing that's going on that's interesting on 21, so these are the 20 cities that make up the CASE-SHILLER 20-city index. And on the y-axis there, the vertical axis, we've got the year-over-year rate of change. And then on the x-axis, we're looking at that 3-month change in that year-over-year rate of change. In other words, is it speeding up? Is it slowing down? And then the bubble size simply corresponds to the size of the market, basically the weightings that CASE-SHILLER assigns to these different markets. So you can see New York is a very large market, whereas Tampa is a relatively smaller market. And the point I would make is that New York, a very large market, is accelerating of late pretty significantly, as are Washington and Boston. Part of why that's the case, if you go to 22, is the fact that the luxury market, really the high-end market, is beginning to show some signs of, what we say getting less bad. In other words, the way we sort of think about the world is that, if something's bad and it's becoming good, then obviously that's positive inflection. A more subtle but no less important inflection would be if something was from a second derivative rate of change standpoint decelerating, getting worse at an accelerating rate, and then all of a sudden it went from bad to, let's call it, less bad. In other words, that second derivative is beginning to modulate a little bit, getting sort of less severe on the margin. And that's certainly what we're seeing in luxury goods consumption. 2017 year to date. And as you can see, if you look at the black columns here, they basically peaked. This is growth in luxury spending. Peaked in 2013, 2014, decelerated in 15, decelerated sharply in 2016. And you could see that pervasively across the high-end home market throughout 2016 and even the back half of 2015. But here early in 2017, we're seeing a bit of the opposite trend, which is interesting. So now, with that sort of backdrop of bigger picture, where are we in the housing cycle, and then sort of zooming in and looking, I guess, a little bit more currently at what's been sort of the recent trend as well as what's our expectation here going forward. I did want to spend some time on one of the biggest, what we call fulcrums or levers in the housing investing landscape, both fundamentally and from an equity standpoint again, and that's interest rates. So 24, just to sort of put it out there. So this is kind of a collection of case studies, and we've got 3 here just to illustrate the sensitivity that housing stocks have had to rising interest rates in the past. So what we did is we went back through time and we looked at sort of expedited periods of rate increases from the last 25, 30 years. So the first case study is October 93 to December 94. During that 14-month time frame, mortgage rates rose by almost 2.5 points, 240 basis points. The S&P 500 home building stocks lost a third of their value during that time frame, and by comparison, the S&P 500 was flat. So pretty significant, both negative absolute performance as well as relative underperformance. Fast forward about 5 years to October 98, in the 19-month span that ran through May 2000, saw mortgage rates rise almost 2 points, so 180 basis points. The S&P 500 home building index during that time frame lost 29% of its value, but what's really crazy is that during that same time frame, the S&P 500 was up 44%. So the relative, so not only did it go down 29% in absolute terms, but it actually underperformed by 73%. So very significant. And then more recently in the taper tantrum, December 2012, September 2013, you had mortgage rates basically rise a little over a point, so up 1.2, or rather 120 basis points over a 10-month span. So how builders do, they basically lost 3% of their value, but during that time frame, the S&P was up 19%. So again, pretty significant relative underperformance during that time frame. So with that sort of backdrop, let's take a quick look and see kind of where we are. So on 25, this is mortgage rates. This is the Freddie Mac Primary Mortgage Market Survey. The 30-year fixed rate mortgage really was at 3.5% through sort of the middle of last year. Sped up very rapidly post the election. Peaked at about 4.25%. Has since cooled off a little bit to a little over 4%. It's at 4.1 most recently. So we're really up about 60 to 70 basis points from where we were roughly 7, 8, 9 months ago. So you can sort of put that in the context of those case studies we were just looking at. On 26, just to give you an idea, housing is an incredibly levered asset, and small changes in rates can have pretty profound effects on affordability, and affordability basically trickles through on a lag to pricing. So to give you an idea, this table's a little bit busy, but this blue row here that's highlighted, the 3.42%, is basically saying that was the average mortgage rate in July through August of last year. And since then, we've moved up. So we've got this highlighted at 3.99, which is when we put this table together back in mid-January. But as you just saw, we're at about 4.1 right now. The column you want to look at is that one that's sort of in the vertical rectangle there, the percent change in affordability. And what it shows is that at 4% mortgage rates, the affordability, meaning your income doesn't really change overnight, but rates can. And if your income stays relatively fixed and you have the same amount you can spend, and this is how most people buy houses, they have their income and therefore the amount they can spend. So you have what are called front end and back end ratios, which sort of work into the underwriting sort of plumbing of Fannie Mae and Freddie Mac, and you have to meet certain criteria in order to be determined eligible to afford what you want to buy. And so the point is, most people sort of buy up to what their borrowing capacity is, which is why rates matter, because they're usually fully maxed out from the standpoint of how much can they actually spend. And so the point this is making is that if in a 3.4 rate environment, that suddenly becomes a 4% rate environment, with the same exact amount of money you spend each month, your purchasing power or affordability drops by 7 points, so 7%. So if you could have bought a $296,000 house, suddenly you're looking at spending $276,000 with the same amount of money. So it's pretty profound, and certainly with the Fed poised here to move in March, they've given every indication, and presumably there's 2 more penciled in for the balance of 2017, and we'll see what 18 brings. I think the path of least resistance is for rates to continue to go higher here. So there is enormous sensitivity, both fundamentally and on the equity side, to housing from increases in rates. And to that end, on 27, we ran an analysis. We looked at the correlation to long-term interest rates across different subsectors. So I cover not only housing but also financials. And so we sort of broke the financials and housing investable subcategories into the 29 or so discrete categories to look at their correlations to long-term rates. And what's interesting is that most of the housing, so there's 8 housing subcategories, and most of them fall towards the bottom of the stack, meaning that they are not positively correlated, rather, but negatively correlated to rates, meaning as rates go up, price performance tends to go down, not surprisingly. So at the very bottom there, you see title insurers, as well as apartment REITs, home centers, which are the big improvement centers, single-family REITs, building products, home builders, and then up at the top, interestingly, you've got the mortgage insurers. So, and then we've got price performance on the next page since the election, and this is a little bit out of date, to be fair. I'm not going to dwell too much on 29, and then 30 and 31 are really just sort of, historical, I guess, dives on price performance across. This first one is across the building complex, and then this next one is across the title insurer complex. And you can see, and we looked at it both against the Fed funds rate as well as the 10-year Treasury, and subsequent 12-month performance in these categories. And what you can see is that as rates go up, price performance in these categories has tended historically at least to be negative. So anyway, I wanted to kind of put that out there. I think it's interesting food for thought across the housing landscape, and if there are questions, I'm happy to take those.
Thanks, Josh. That was awesome. Yeah, we have quite the queue built up here. We'll start with this one. From a long-term cycle perspective, is the setup for housing still positive? Is there more opportunity or asymmetry in the existing or new home market?
Yeah, so I touched on this in the beginning. I mean, it's still very asymmetrically positive on the new home side. And that slide on page 6 that shows, again, resi construction as a percent of GDP, I think is probably the easiest one to wrap your head around. But I've got a bunch in here. I mean, I've got this affordability chart on slide 10. I've got this long-term total starts chart on slide 7. So there's a lot of, I think, pretty simple illustrations here as to why there's a lot of still long-term upside on the construction side. The existing market, however, is very different. I think the opportunity for upside in existing really revolves around this idea of the sort of renormalization of the first-time buyer, meaning that if you look back prior to the Great Recession, the first-time buyer had typically tended to account for about 40% of existing home sales. But since the Great Recession, that number has been in the low 30s. And a lot of that has to do with strict underwriting standards and lack of down payments and underemployment. And when you take all those things into account, basically the idea is that if you renormalize that first-time buyer back to where they had been prior to the Great Recession, which is probable but will still take many years, then you could probably get to a case where you've got another 10, maybe 15% upside to the existing market, but by comparison, you've got arguably 60% upside in the new home market.
Awesome, thanks. How about, are we still constructing at a deficit to new household formation? Can you give a quick update on household formation and the supply-demand balance?
Yeah, so again, just to call out some slides in here. So new household formation, trailing 12-month average has run about 1.3 million. There's this thing that we call sort of the golden ratio, which is basically we get it from the JCHS, which is the Joint Center for Housing Studies at Harvard. They put together these long-term sort of 10-year forecasts for household formation, construction, and they're based off basically sort of the trends that have been going on in the country post-World War II. And what they find and what they project, at least historically, is that for every household that gets formed, you actually need to build roughly 1.35 new houses. And the reason it's more than one is because you have second homes, vacation homes, vacancies, demolitions. So when you take all those factors into account, you really need to be building almost 1.35 units or 1.35 units for every household that gets formed. So if you say, okay, well, in the last year, on a rolling 12-month basis, we've formed 1.3 million households. You'd gross that up by a factor of 1.35, which would get you to, I don't know, 1.8, 1.9 million is sort of what you would need to be building. But as we show on slide 7, we're actually only at 1.2. So there's a solid deficit, construction deficit still of 600,000 units relative to the amount of household formation that's going on.
All right. Do we, let's see here. Do we have any update on the luxury market and more specifically the New York area and New York, Connecticut metro area?
Yeah, the luxury market, we had a slide in here, and sort of slide 22, that basically looked at the luxury market. And this is luxury goods consumption, but again, a pretty noticeable positive inflection that's taken place here early in 2017. And I think the thing to think about with the luxury market is it had been getting worse for 2015, worse still, significantly worse in 2016. And I think we may finally be at a point where we're starting to bottom out. We're starting to sort of undergo that phase transition from sort of worse to, I guess, less bad. That's sort of how I view it.
Okay. Let's see. QM and mortgage interest deduction were once on the table as part of tax and regulatory reform. Are these both on the table or off the table now?
Well, it's hard to know because we're still in the early days of what tax reform might look like. Up until recently, there had been talk of changing the mortgage interest deduction cap from the Treasury Secretary, Steve Mnuchin. But then more recently, he's made comments publicly that they're not going to look to make changes to that. On the QM side, and for those who are unfamiliar, QM is short for qualified mortgage, and it's a set of rules that went into place early in 2014 that were mandated under Dodd-Frank that really made it very, very difficult for about 15% of the working population to get a mortgage for a variety of reasons, but really things to do with non-W-2 wage earners, people whose incomes were harder to document, and therefore get approval from a bank from an underwriting standpoint. So there's been efforts within Congress on Capitol Hill to try and roll back some of the QM regulations. My understanding is that, at least for now, there is no real indication that any progress is going to be made on that in the foreseeable future. Okay.
And to go on the regulation point too, what other factors impacting the high end, like foreign demand and the Treasury FinCEN crackdown, are those getting any less worse on the margin?
So people probably are not all familiar with what we're talking about here. So The Treasury Department of the United States has a division which basically cracks down on financial crime, and specifically in this case money laundering. And what they've suspected for a long time has been that high-end real estate has been sort of a go-to vehicle for money laundering among foreign buyers for years. And so they ran an analysis where they looked at people who were buying high-end properties using LLC, legal structures, basically shell corps, where there was no named buyer. And the numbers were pretty interesting. Like if you looked at places like LA, San Francisco, Miami, Fairfield County, anywhere from 20% on the low end up as high as almost 60% on the high end of people buying properties, north of $5 million, were doing so with shell corps with no name buyer. And the Treasury Department, specifically the Financial Crimes and Enforcement Division, the FinCEN unit, suspected that a lot of these transactions might be for purposes of money laundering. And so beginning about a year or so ago, they rolled out this pilot program in Manhattan and Miami where they said any transactions north of $3 million in Manhattan or $1 million in Miami can no longer be done without a named buyer on the LLC. So for the past year, they've been tracking the people's names who've been put on these and cross-referencing them against their existing lists of people who are sort of people of interest, meaning suspected of financial crime like money laundering. And what they've announced is that a pretty high percentage of the two, if you do sort of a Venn diagram, the overlap is very high. So like a third or almost a third of these people who are being named on these purchase agreements are people who are suspected of money laundering. And so they've expanded that program beyond just Manhattan and Miami to all of New York City, the sort of surrounding counties around Miami, to now the West Coast, to LA and San Francisco, to the county that surrounds San Antonio, as well as a few other places. And the idea is that it'll run through basically August of this year. And then at that point, it's a little unclear what they're going to do with it, but I think most people expect that they're sort of going to emerge from this data gathering phase into an enforcement phase. So we'll see ultimately what that looks like. The effect it's had, however, seems to be that it's cooled off demand in the high end in some of these markets. So it certainly cooled off or helped to cool off New York and Florida. It seems to have had a little bit less of an effect on California. And there are a lot of different factors at play here. So sort of New York has a supply problem, as does Miami. So how much of that is what's causing the weakness there versus this FinCEN situation? So it's not entirely clear how much of a role this is playing, but we know that it's a factor on top of other factors, and it's something we've been watching.
Awesome. I think we have time for 2 or 3 more. Historically, HPI has generally followed the slope of demand growth on a lag. Is the unusual supply situation the primary cause of the divergence in that relationship?
Yeah, so most people probably have no idea what you just said, so I'll explain it. So what Chris is alluding to is this idea, we've done a lot of work on this, that if you look at the rate of change, the year-over-year growth and demand for housing, it tends to lead rate of change in price by about a year. And that's because housing is a sticky asset. It takes a long time for, let's call it reality, to kind of sink in on the part of sellers that they're not priced competitively, and so they have to take down the price. And that's sort of the mechanism by which housing prices adjust. And this sort of 1-year lag between demand and price has sort of been a constant. What's interesting today is that demand is not growing, and historically you would not expect to see HPI growing by more than the rate of inflation in that environment. But what's sort of unique about this environment is that the reason demand is not growing is because there's inadequate supply. And that tight supply, we sort of call it the HPI tug of war between tight supply and not growing demand. And frankly, we were unclear which way this was going to sort of break. But it seems like And we have this slide in here that sort of shows, again on slide 20, it seems like, at least in these most recent couple of months, the supply side appears to be winning the tug of war. So we're starting to see upward inflection or acceleration in home prices. So I think that's sort of the early read. We'll see if that ultimately proves to be the right one, but it certainly seems it passes the sort of reasonability test.
Awesome. And then one last question. What is the near-term expectation for existing home sales? You pointed out the recent decoupling of EHS from PHS on the macro show. In what direction should we expect this to resolve?
Yeah, so I mean, there's sort of the bigger picture and then maybe the sort of shorter term catalyst side of it. So bigger picture, I would go to slide 15. Sales of existing homes really have not grown at all for the better part of the last 6, 8, 9 months. We have no reason to expect that that is going to improve. And again, the governor there, the anchor, is really supply. There's not a lot of supply, and in fact, all indications suggest that supply is continuing to shrink. And so in a shrinking supply environment, it's going to be hard for volume to increase. Now, that being said, if you want sort of a shorter term read, and I talked about this earlier, but on slide 16, there is, for whatever reason at the moment, sort of a short-term dislocation, disconnect between the pending and existing home sales readings. So pending's been trending lower, existing has been accelerating, and because pending is the leading indicator for existing, we would expect that this upcoming print for existing, and probably the one after that as well, is going to come in below expectations.
Awesome. Well, and that's all we have time for today. Thank you, Josh, for joining us, and thank you for tuning in. We hope we're able to provide some valuable insights. Please join us next Tuesday at 2:30 for a technology sector spotlight with sector head Ami Joseph. Thank you.